Hello everyone and welcome to the Cyclical Investors Club YouTube channel. This week I have a broad focus on financial stocks. There's been a lot of talk on Bloomberg this week about how well financial stocks are doing, about how there's a general rotation into financial stocks, about how interest rates are probably going to go up more than people expected, and about kind of value, a little bit less on the valuation of them, but somewhat how they're cheaper relative to the market. Usually financial stocks are pretty boring. I mean, unless you're talking about fintech, which is not exactly what I'm talking about here. I'm talking about more banks and asset managers, basically. Banks are really interesting to me because for a long time I avoided them. A lot of people value them on like price to book, and when I did research, I just found that it wasn't a very reliable predictor of future returns for the stock investor. Maybe 30 years ago it was, but I mean, I just wasn't finding the evidence where I could really evaluate them confidently to where I knew I had a high probability of getting good returns. That kind of changed in the last year or two. I did a little bit more research. I just kind of tried to learn more about how banks worked, and then constructed kind of my own way of thinking about it. And one of the real game changers was actually Becky Quick was talking with Warren Buffett about how to value banks, how he valued banks, because he owns a lot of banks and he has over the years. And he basically said he evaluates them exactly the same way he evaluates any other company. He looks at their earnings. And that really caused something to kind of click for me, where I was like, well, if Warren Buffett's really mostly just looking at their earnings and their earnings capability, then I could probably just look at earnings too, even though that's not how most people evaluate bank stocks. And so once I did that and I learned a little bit more about banks and how they're just a little bit different, other metrics I can pay attention to, which ones I can't. I got pretty good at kind of picking banks and evaluating them and figuring out what good prices to buy. Not as good as an expert, but given what I do, since I work across a wide variety of industries, I don't really have a lot of industry limitation. Being able to add some banks when they're cheap worked out really good for the portfolio. So they're pretty boring. I mean, you never get excited when you buy one. So I'll give you an example, since it's in the S&P 500. I bought PNC on the market, I think it was March 23rd, 2020, about the same day the market bottomed. And I remember that when I bought it, it was just like, oh man, I really don't want to buy this stock. I really don't think it has like some super bright future or anything. But when I looked at the numbers, like the numbers worked. And I was like, well, I'm just going to stick with it. I'm going to trust the numbers. It says the stock's cheap enough to buy and that I can get a good return if I buy here. So I did. And now PNC's up almost 100%. I mean, and it wasn't just them. Right now I have 14 stocks that I bought this year. My top 14 stocks that I haven't taken profits in yet. Of those, half of them are banks or asset managers, and the average return has been 85%. So none of these are really exciting, but if you buy them cheap enough, if you're patient enough, and if you only buy them when they're really cheap, they can produce very good returns. And the great part about it is most of them, while they've gone up a lot, they're no longer bargains really. They're still fairly valued. So, I mean, I haven't taken profits in any of them yet, and they still could go up. I mean, I think they could go up another 20% on average probably before I'd even get close to maybe saying, okay, they're overvalued enough to sell. So there's still probably upside left into this, and especially if rates start to tick up a little bit, or even if people think they are. There's money to be made in banks. Now, everybody's talking about banks and coming in and buying them. That's great for me because I already own a bunch of them. But it doesn't mean it's the best time to be going out and buying banks now. The best time was earlier this year. I think for most of them, I bought in March, US Bank, USB, I also own that. That dipped a lot in May and went down and touched March bottoms, and I was able to, even though I missed it in March, I was able to pick it up, basically bottom ticked it then. And so that's done really well. It's up like 60%. So, but I did find a couple smaller banks. One of them is not in the S&P 500, so I'm not going to talk about it. But the one that I am going to talk about today, it's up about 15% since I bought it. 15, not 50, because I bought it just a couple months ago. But it is in the S&P 500, and I still think it's fairly valued. Like, if you want to get in on this bank trade, the market has a little less confidence in this bank, but it has a good track record and it's still pretty cheap. And so I think if they surprise the market a little bit, then you can still get into it. And it's People's United Financial, ticker PBCT. And that's the bank that we're going to talk about being a buy in this video. Before we do that, I'll take a look at some of the other buy suggestions. Okay, before we take a look at this week's buy idea, I want to take a quick look at the ones that I've suggested over the past month or so since we started the channel. As we can see here, the big outlier here is Anthem, which is down about 14%, and that's really hurting the returns of the buy ideas that I shared. But most of the rest of them are doing pretty good. 5%, these are all up 3%, Facebook's up 3% in a week. So we still have positive returns, absolute returns, which is good, but we're trailing the S&P 500, which is up 2.6% if purchased at the same time, as I suggested the stocks. And that Anthem position's kind of keeping our relative performance down a little bit so far. We'll add this week's buy suggestion here, and we'll keep tracking these over the next few years, and we'll see over the longer term how they all play out. I think the Anthem performance has a lot to do with the government regulation that they think is coming, that the market thinks is coming, and that I'm kind of trying to look through past. It does seem to be bottoming out here a little bit, so we'll see if it can kind of hold its own, and hopefully the rest of these ideas that I come up with will be able to counteract the occasional loser that we get. So this is pretty accurate. I mean, pretty typical. Usually about 4 out of 5 picks I get right, and then about one of them struggles. And so, but we'll see over time how this all turns out. But I thought I'd check back in here, show everybody how we're doing before we get on to this week's buy idea. Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's video. Okay, let's take a look at People's United Financial. This is probably the only bank in the S&P 500 that I think looks attractive here, and probably it's going to require some good news eventually in the next couple of years, some surprises to the upside for them to really produce great returns. But if you compare them to the other banks whose prices have risen up to at least fair value now, I think this is probably the best value bet that you're going to find in terms of kind of banks and asset managers in S&P 500. I bought this one a month or so ago, and it's up about 15% since then. So it's off to a good start, and it's trending pretty good. We can see the momentum's definitely moving up to the upside here. So, but first let's zoom out and take a long-term view here. So I have certain quality standards that I like to have before I buy any stock. And we can see long-term that we have a general trend in the right direction, for, going from left to right, going up. And then we have a little bit of dip this year, which is expected because it's a recession year. And then the expectations are basically flat for the next few years. Okay. So that's kind of where we stand. Now, the first thing I like to check when I look at a stock, other than just this kind of basic earnings pattern, which is the dark green area here, is the historical cyclicality of earnings. And back during this recession, we see a 60% drop in EPS. Here, about a 50-ish drop in EPS for both years together. Now, that's right on the border of what I would call a cyclical stock. And I think it would be okay to treat People's United Financial as a cyclical stock. And we could look at it that way. But the difficulty with that is usually I use price cyclicality in order to help guide when to buy cyclicals. And People's United was really overvalued going into the last recession. So it traded at a 44 PE. This just kind of shows you when I make my articles where I'm like, consider taking profits, or my sell articles, even if the company is a good company, when they're selling at a 40 PE, it can be very hard to justify that PE over the long term. And we can see that if you bought in this area back in, 2007, we won't even pick the very top, we'll pick right here and then go to today. You would have made 1% per year, including that includes dividends. So you would not have had good returns, even though there wasn't anything really wrong with the business. Whoever bought during this period just paid way too much money for it. So we want to pay very little money is the goal. But since it was so overvalued here, I don't think it's likely that the stock will, at least in the near term. We can't dependably assume that it will trade at like a 42 PE even at the peak of the next cycle. So we've had a lot of multiple compression. If you go back to here at the last peak, it was only trading at 18. That's more reasonable. So that makes more sense. So using the price cyclicality isn't going to help us very much if we treat this as a cyclical. So I'm going to treat this as a moderately cyclical stock. And I'm just going to make adjustments, or we can make adjustments for these type of down years. In this analysis, I'm actually not going to do that because I think we're kind of early cycle right now. So at least in the medium term, I don't see a lot of risk to this giant downside that you would see in earnings during a normal recession. Okay? So I'm going to be a little bit optimistic when it comes to that, but I'm going to be a little bit pessimistic and include these kind of moderate down years here that we had. Okay? So when I try to estimate earnings, I'm going to move this graph up to 2012. All right, since we just had a recession and we're just coming out of a recession now, I'm basically trying to match that with history so we can see how we did back then. Basically, we have kind of a full cycle here with a recession here at the end. Now, you'll see it's not as bad as kind of the recessions that we've had before because we got a lot of stimulus. So I would keep in mind two things here. One, my earnings growth estimates are going to be a little optimistic. And two, if we see the economic cycle start to turn down in a couple years, in 2 or 3 years, if it starts looking like kind of a recession might be coming, then this is a stock we might want to take profits in early. You definitely wouldn't want to hold it through. So we're going to have to be able to eventually predict the next recession to make this purchase kind of reasonably safe. And as long as we can do that, which I'm usually pretty good about doing that, we'll be okay. This isn't one that we want to hold through the next recession if we can help it. So that's important to keep in mind. Now, if you wanted to hold it through the next recession, you could model in some of these earnings decline, some like a 50% earnings decline or something. You could do that. And then your growth rate would be a lot lower. But I think looking over the medium term, starting here makes a lot more sense. And then we'll just be on guard for when the next recession might come. Because when it comes to banks, we're early cycle right now. So maybe getting into mid-cycle as they get more expensive, but in terms of like earnings, we're still early cycle. So there should at least be 2 years left of up cycle here, and probably more unless kind of something strange happens. And so we'll keep an eye on that. So these are the parameters that I'm using. You can see the normal PE ratio here is about 16, and we're, according to Fast Graphs, we're at 11.5. Let's see what I have on my calculations here. So we go into my spreadsheet. So again, we have the full cycle average PE. Right now I have about 11.5, the same as Fast Graphs. If this 11.5 PE goes up to 16 and 16.61, that'll, over the course of 10 years, that'll result in a 3.7% CAGR just from the market changing its mind. So imagine that they put together a couple decent years. They're only expected to be flat in 3 years. Let's say they grow at like 5% or something, grow earnings at 5%. Then people say, oh, well, they aren't a no growth company. They're a slow growth company. And that might be enough if interest rates are still not crazy, for it to trade up to their average PE. Okay. And so that's how this comes about. Now, they actually have issued shares, okay, over the past cycle since 2012, about 20% more shares rather than buying. A lot of times when I look at companies now, they have bought back a lot of shares. These guys are probably buying other smaller banks. But for banks, one of the things I learned was it really is possible. I mean, they're so similar that it's possible for a bank that can buy another bank and actually make it more efficient. You know, they have less overhead, and maybe the higher quality bank has a little bit better standards of lending and so forth. So it's okay for banks to be buying each other, and we should expect that over the next year there'll be more consolidation. We have a lot more banks than we need, basically, and they'll consolidate more and become a little bit more efficient. And so the shares outstanding is no big deal to me. And general acquisitions are not a big deal. Whereas with other companies, if they had made a lot of M&A, that kind of sends up red flags to me. And usually I'll just avoid them if it's over 20% of the company. This one actually is right at 20%. So it's right kind of in that sweet spot we might expect. The Fast Graphs earnings per share growth is at 5.2. Mine's a little bit higher. That probably has to do with the fact that Fast Graphs will calculate in this 20% issuance of shares into the EPS. So, and that kind of makes sense when we look at it. Okay, so this cyclically adjusted earnings growth, is a little bit faster here, and it's probably a little optimistic. It includes this decline, this 9% decline, and it also does include this 26%, and that is a lot of that's almost certainly due to tax cuts, which probably won't happen again. So I would say my 6% estimate here is probably very generous, and it's probably only going to hold true if we sell the stock before the next recession, basically just echoing what I said earlier. You're probably looking at more like a 4% growth rate if we include a recessionary downturn and we exclude the benefits of the tax cuts from 2018. So I'm going with 6%, again, fairly generous. Now, fortunately, the stock's trading at such a low PE that if you get a 6% growth rate on an 11 PE stock and you invest $100, after 10 years, you'll get back $223, including the original $100. And that works out to an 8% business CAGR. Okay, so the business is probably going to earn around 8%. If we wanted to be more conservative, I mean, if we just want to, and I can change the numbers here. So let's say we want to be more conservative and we'll do 4%. So that would be like a 7% business CAGR, which still isn't bad. And then that would be an 11% if we combine it together with the mean reversion. So mean reversion plus business gives you the 10-year CAGR, and that's pretty respectable given where the rest of the market is right now. So even if I wasn't quite as generous, we would still do okay. But where we're at right now, we're at my 12% threshold, which is kind of my rough threshold for considering something a buy. We can see that because the growth rate's pretty low, the PEG ratio is a little higher. So this is definitely a slow growth company. Now, one of the things I like to see, well, before I get to that, we'll take a look at the 3-year revenue is pretty good here. That's almost certainly because they probably bought a bank or something like I was talking about earlier. I wouldn't expect 10% revenue growth from here without more acquisitions. But what I want to focus on here is the shareholder capital allocation. What this is it takes the dividend yield and the buyback yield and combines them together and shows what percentage of the earnings yield that represents. And it should give you an idea how much money they're actually returning to shareholders out of their earnings. And they're returning about 60%. Now, if they were kind of a no growth company, if this was maybe below 3%, I would want to see this up closer to like 85 or 90. But in the 5-ish, 6% range, returning like 60% of the money to shareholders is pretty reasonable. And I want to say they have a pretty high dividend yield. Let me go check. 5%. So you're getting a good dividend. Wait, maybe that was a shareholder yield. Yeah, no. So yeah, they don't have a buyback yield because they were issuing shares to buy other banks. So you're getting like a 5% yield. That's pretty good and relatively safe, boring. But when the rest of the market's trading at like over a 3 PEG ratio, you can get a slower grower like this. And if they get a couple breaks their way, things kind of shift in their direction and they can get that 6% growth, you're going to do really well. And the market will probably, sooner than you think, adjust to that. So this mean reversion is spread out over 10 years. If it happens over 5 years, then it's going to be a much faster, quicker gain. So you could easily see the stock up 50%, I think, over the next 2 years or 3 years, if a couple things fall in their way. I don't really have too much to say here. Again, if you already have a bunch of banks or whatever, this might not be super duper attractive. If you don't have very much cash on the sidelines, again, this might not be the first stock you'd go out and buy. But if you don't have very much exposure to banks or asset managers, and you want to kind of balance your portfolio out a little bit, or you have extra cash or cash that's coming in every month and you really want to put it to work, kind of these quiet stocks like this can be really good places to park it, and you can still do pretty well over the medium term. Really quietly. Like I said, all my boring banks and asset managers, they've returned me an average of 85% this year when I was able to buy them really cheap. That doesn't include this one. Those are the ones I bought earlier this year. I just bought this one a few weeks ago. But I think in terms of banks that are in the S&P 500, this is your best value pick right now. All right, thanks for watching the Cyclical Investors Club YouTube channel. Click the subscribe button if you haven't done that yet. Each week I try to share a buy idea, a sell idea, an avoid idea, and then I also have like a topical video that I talk about just general investing ideas and concepts. Thanks for watching. See you later.